This is where we delve a little deeper into the headline that you might have heard to give you an actionable insight into what could emerge as an opportunity for you on the investment side as well. Now, as Niraj has already pointed out, there is a case of exuberance, one might argue, in certain pockets, and it's a little hard to understand why a lot of money is chasing after a few of these stocks, and I think Niraj has a strong point to make there. But we will also talk about something that we don't often talk about, and that is fixed income. Is this the time for you to pivot like the central banks are and take a closer look at your fixed income strategy, because this might be a golden opportunity, and we'll tell you why. Samina will help me lay that argument out for you. But let's start, Niraj, with money chasing fast money, as you pointed out.
Yeah, you know, Samina has for 2 days on a trot brought out this point of this SME IPO, which has gotten massive monies, but I'll save that for the last. Okay, first a few other points. So Sterling Wilson Solar, we spoke about it getting these order wins. Now, circa 12,000 crores worth of demand for a 1,500 crore QIP. That is large sums of money chasing a stock like Sterling Wilson Solar. Remember, Sterling Wilson Solar, the history, this we are not putting out on air, but the history of Sterling Wilson Solar, that just about a year ago, it was not considered to be the the stock that darling of the street, that people want to chase it so much. And suddenly we're seeing some change of plans. They've met active investors around what to do, and the stock has gotten the kind of demand that it has. So that is Sterling Wilson Solar, the first up of the block. SpiceJet, it was virtually an untouchable airline. Right?
And we have spoken in the recent past, Niraj, 89% of the market controlled by two entities.
Two entities, right? Which is Interglobe and Air India, right? SpiceJet gets 2,200 crore rupees. Yes, there was an absence of marquee names because it was believed that, oh, maybe a very large prominent world global fund will come in, or a large other airline person will come in. That didn't happen, but it got the money.
Yes.
Yeah, and sure, the stock has come off from the recent highs, but it got serious amount of money. J&K Bank, the QIP, saw a demand of over 20 times. You know, we were thinking that a QIP happening at a 10% discount will see the stock come off. The stock was up 9% that day simply because of the health of the demand. And then the SME IPO. 18,891 crores worth of bids for a 78 crore IPO. Guys, there's just a serious amount of money chasing a few ideas, and I think there is a rumor. Sorry, just one last one. There's a talk. I know you want to come in on the SME IPO.
Go on, you finish.
No, I'm just saying that there are a few QIPs that are slated to happen if Grapevine has to be believed. It will be very interesting to see what's happening to those block trades or those QIPs over the course of the next 15 days.
You know, Niraj, while you mentioned that this euphoria continues, I still remember exactly about a year and a half ago, everyone was talking about how easy money is going to stop because valuations were going, there were financials that were getting valuation at 10, 15x. Tech companies, let's not even talk about what they were getting, right? And there was a general sense that this era had ended and was taking a break for the next few years, right? But from what we are seeing right now, I don't know where this money is coming from anymore because the euphoria doesn't end.
Maybe the funding winter in the startup space is moving to the secondary markets.
Also, the market is preempting that if we are looking at a rate cut cycle, then let's look at EMs, which will benefit. Okay, EMs, which are the EMs? BRICS. You look at Brazil, India, Russia, China. You look at India probably looking like a bed of roses relative to everything else in the system.
But is it really FII? Is it foreign? It's not necessary.
No, I'm just saying, so at large, en masse, there is this global money coming in. And then local money, right? We've spoken about how the local SIPs, we speak about local SIPs so regularly, we don't talk about the kind of money that is coming into the PMS and the AIFs, right? Samina has great insight there, but just the quantum of AUM has jumped up.
On that note, the likes of a Unify have stopped receiving fresh money.
Yes, a lot of them have.
Which is huge, right? Now, whether or not this is because they've got a mutual fund license coming or they don't have ideas. Because at the end of the day, a PMS is supposed to be more concentrated strategy. But yeah, they've actually said no more fresh flows.
And interesting, I remember this in a chat that you were doing recently where the manager said that we have received funds, but we have the leeway to hold for a period of a couple of months before we deploy completely, and we utilizing that leeway.
Yeah, I think that
So
was
all-
Rishabh Sheth
all
of
Yes.
Karma, if
and
I'm
all
not wrong.
PMSs
Yes.
usually do that, right? AIFs and PMSs have the ability to sit on cash before they SIP or STP their investments. But yeah, the euphoria is here to stay, I'd like to believe.
And just the size.
But what's the bottom line
just-
according to you, though?
No, so the bottom line is just this, that for now, I mean, we've been talking about it on the trade setup every day, that the party is looking stretched. But at some point of time, these are cautionary signs. This has happened umpteen number of times in the past. Once the market corrects, which it eventually will, everybody will say that, hey, these were telltale signs.
Yeah.
But until it
happens.
hits,
It's
nobody quite
always the
realizes it.
hardest point. I mean, of course, it's the hardest point to.
You can't time the top,
You
right?
can't time the
But
top.
these are slightly discomforting signs, you have to be honest.
Fair point. All right. So, but on that note, and I think this leads very nicely into our next chat, which is on fixed income, because generally, from a personal finance standpoint, you would say you book from equity and you push into fixed income. I would argue, Samina, that this is a golden window for you to put money into fixed income. And if you're talking about bonds, right? Because it works this way. If the interest rates go down, prices are going to go up for existing bonds. And if you buy early, you get the benefit of that price appreciation. And if you can lock your yields in right now at around 7.5%, 7.6% for a few, target maturity funds, which allow you to hold to maturity if you do want to do that, you have the potential in the next 3 years of maybe getting that capital appreciation as well.
So just to quickly comment on that, right, and talking about euphoria, historically, debt is supposed to be a risk management tool for stable investments. If you want alpha, you go after equity. If you want safety, you want, your portfolio being comforted, you look at debt. But with the euphoria around, we're now even discussing investing in debt because the timing is correct. Debt has never been about timing it, right? But just to comment on your point, and let's break this down. Rates have peaked. Liquidity is tight, so we aren't expecting any OMOs coming through. Rates, after what we saw in the Federal Reserve meet that happened recently, the anticipation is that India will cut rates. Now, whether they do it over the next 6-month period or they do it over the next 1 or 2 years is anybody's guess, right? But cuts are coming, which also means that we've peaked on our current tenure. Now, if I have to break this down, while you said yield is, so the two ways to make money on debt investments is either through
interest rates,
yield or through your M2M, which is a capital appreciation. If you hold to maturity, the only return you're yielding is your yield.
Correct.
This instrument where you're trying to trade a debt income debt as an asset class for the short to medium term also means that you've got to time it, enter today and exit it over the next couple of months or the next 1 year once rates start coming off. All of this depends on how sensitive your portfolio is as well, right? So if I've got a medium-term duration portfolio with a 5-year maturity, and I'm just going to break this down for the sake of our viewers, where your paper is 5 years, rates come off by say 1% in the next 1 year. I've entered at 7, rates stand at 6%. Which means what I do a year later, if I want to exit this asset class, my take-home returns on that is 14% pre-tax. Now that's a really sweet spot to be in. But the other critical angle to watch out for is if you enter debt as an asset class, there's always a reinvestment risk. You enter at 7, you get out at 6. What happens then with that money, right?
That's a very
Are
fair
you going to
point.
move it to equity? That's the question to ask. If you're going to stay in debt, you're locking in your yield at 6% now.
But that's a sweet problem to have. Let me get the returns first, then I'll think what to do with it.
But it's a fair point from a personal finance planning perspective,
and it depends
Niraj, one
on
would
what
argue, because
your objective is, Niraj.
because you plan, exactly. So you plan saying that I can lock in 7.6%
For
now
the next 10 years,
for the
right?
next 7 years.
Yes, but it's good to have that option, right? That
Sure.
I've locked in my rates, but
Which
if
is
I'm
my
getting
argument.
14%, and if
Very
I have
greedy
the
both of
option,
you are.
Which is my
why
argument.
not? If I'm getting the money,
It's
why
win-win.
not?
It's win-win
It's
because
a sweet spot.
if
and
you're
I think,
uncertain,
if your risk profile is high or moderate to high, I would say you could look at a long duration paper.
Absolutely.
If you are conservative, so I think somebody wants to draw the middle line or the middle ground, medium term paper looks good. So your 4 to 5 year sensitivity, so which really means that your underlying is in the range of 5 to 6, 7 years maybe. In a case like that, rates will come off, you make your M2M, which is capital appreciation, and then you have your yields. Another thing to note is post the budget, taxation is
I was
at your
going to point
marginal
that
tax
out.
rate.
Yeah. So very quickly, for those of you who aren't familiar with this, and this is the closing point, if you are looking at investments into fixed income mutual funds, all of the gains from that are now treated as short-term capital gains after the change earlier in the year, and you will be taxed at the slab rate. Now, this is basically bringing these products on par with a lot of other fixed income products like fixed deposits, and so therefore the benefit that was being received by fixed income mutual funds no longer exists. But the argument is that you can make money on the interest rates and potentially on capital gains as well. We will hold this conversation for later when we perhaps do the mutual fund show, and we'll get you actionable insight if you intend to deploy into fixed income mutual funds.